Today's economic numbers have once again painted a picture many of us are already feeling. The U.S. economy is giving off some seriously mixed signals. Some parts look strong and stable, while others hint at some pressure and uncertainty just beneath the surface. Let's break down what this actually means for you. First, the good news. Recent federal reports show that the economy is still growing, just at a modest pace. You and I are still spending money, jobs are being created, and key sectors, especially services, are holding up pretty well. But on the flip side, inflation is still stubbornly high in some areas, borrowing money is expensive, and it seems like everyone's feeling a little nervous about their finances. This mix has left the financial markets spinning. Stocks went up and down, bond yields wobbled, and investors are all trying to figure out where we're headed next. So what's the real story behind these numbers? While the overall economy is growing, it's doing so much more slowly and unevenly than before. Think about your own spending. You're probably shelling out more for essentials like your rent or mortgage, healthcare, and insurance. But when it comes to the fun stuff, like travel, big-ticket items, or eating out, many of us are pulling back. This isn't just a random detail, it's a huge clue. It shows that we're adapting. We're still spending, but we're being much more careful and prioritizing needs over wants. That signals caution, not confidence. The job market tells a similar, complicated story. Overall, employment is still strong. We haven't seen massive, widespread layoffs, which is great. However, job growth has definitely cooled off. Companies are being more selective about who they hire, especially in fields like tech, finance, and other white-collar professions. And what about our paychecks? While they're still going up in dollar terms, the raises aren't as big as they were a year or two ago. For many of us, that means our income just isn't stretching as far once you factor in inflation. And speaking of inflation, it's still the elephant in the room. Prices aren't skyrocketing like they were, but they haven't exactly come back down to earth either. The core costs for things we can't avoid, like housing, food, and medical care, are still climbing at a rate that has policymakers and all of us pretty concerned. This whole situation creates a real dilemma for the markets. Investors are trying to guess if we're headed for a soft landing, where inflation cools down without causing a recession, or if these high interest rates will eventually choke off growth altogether. Today's data didn't give a clear answer, which is why the market's reaction was so wishy-washy. Stocks were a mixed bag, with some sectors up and others down. Companies that rely on us spending freely felt the pressure, while more defensive stocks did okay. So, what's the big takeaway here? The economy isn't in a crisis, but it's definitely not out of the woods yet either. It's like it's walking a tightrope, supported by steady jobs and spending on one side, but weighed down by high costs and cautious feelings on the other. Next up, we're going to dive into how the people in charge, like the Federal Reserve, are reading these signals and what they might do next. As everyone tried to make sense of the latest economic data, all eyes turned to the policymakers, especially the Federal Reserve. What will they do in the months ahead? For now, their message is simple and consistent. They're letting the data drive their decisions, not a predetermined timeline. And today's mixed-up reports just reinforce that cautious approach. For months, the Fed has been walking a fine line, trying to get inflation under control without wrecking the economy. And their main tool, high interest rates, has definitely had an effect. It's harder to get a loan, mortgage activity is way down, and businesses are finding it tougher to borrow money. But at the same time, the economy hasn't weakened enough for them to just hit the brakes and start cutting rates. This is where today's data really complicates things. Inflation is better, but it's not good enough to declare victory. The economy is growing, but not so strongly that we can ignore the risks ahead. As a result, those hopes for quick interest rate cuts are starting to fade. Markets reacted instantly. Investors who were betting on rapid rate cuts pulled back and adopted a more wait-and-see attitude. This was reflected in the bond market and in sectors that are really sensitive to interest rates, like housing, banking, and technology stocks. From the Fed's perspective, this data probably confirms that they need to be patient. They're not going to make a big move based on one report. They'll be looking for clear, sustained trends over several months before they act. And it's not just the Fed. Government spending is also playing a role, propping up parts of the economy through investments in infrastructure and other public services. But the ongoing debates and political divisions in Congress over budgets and deficits add another layer of uncertainty that can make markets nervous. For businesses, the message is also mixed. Many companies are seeing steady demand for their products, but rising costs and expensive loans are making them think twice about expanding or investing. They're being more targeted with their hiring instead of just bringing on lots of new people. Small businesses in particular are feeling the squeeze. Higher interest rates make loans more expensive, and rising costs eat into their profits, leaving very little room for error. The housing market is a perfect example of how all this comes together. High mortgage rates have made homes unaffordable for so many, slowing down both buying and selling. Even in places where home prices are stabilizing, just getting into the market remains a huge challenge. All of this contributes to a general feeling of economic uncertainty. It's not panic, but it's a persistent, nagging caution. The markets aren't sounding the alarm, but they're not celebrating either. They seem to believe we're in for a period of slow, careful movement, guided by policy decisions and our own consumer behavior. For many of us, all this economic data can feel abstract, just numbers on a screen that don't seem to connect with our daily lives. But these mixed signals are directly tied to our household finances, our job security, and our plans for the future. For working families, the number one issue is still the cost of living. Even though the big inflation headlines have cooled, the cost of essentials continues to stretch our budgets thin. Rent, utilities, healthcare, and insurance are still high, leaving less and less money for savings or anything extra. And while our wages are still rising, it's happening more slowly. For a lot of households, paychecks just aren't keeping up with the rising costs. This can create a lot of financial stress, even if you still have a steady job. The good news is that job security remains relatively strong. Most people who want a job can find one, and we haven't seen the kind of mass layoffs that would signal a major downturn. That stability is a huge reason why the economy has managed to avoid a bigger recession so far. Still, all this uncertainty changes how we act. We're more cautious as consumers, putting off big purchases and sticking to the essentials. And that caution feeds right back into the economy, influencing business decisions and overall growth. For anyone with a loan, interest rates are a huge deal. High rates affect everything from mortgages and car loans to credit card debt. Even people with stable incomes might hesitate to take on new debt right now, which slows the whole economy down. On the other hand, savers are finally seeing some benefits. Higher interest rates mean better returns on savings accounts and other investments, which has helped some people, especially retirees, offset the sting of inflation. So, what happens next? There are a few different paths we could go down. If inflation keeps cooling off and the job market stays solid, the economy could settle into a period of slow but steady growth. In that best-case scenario, interest rates might eventually come down, making things more affordable. But if inflation proves to be more stubborn, or if the economy weakens more than expected, policymakers will face some tough choices. They'll have to decide whether to risk a recession to get prices under control. For now, the data suggests we're not heading for either extreme. Instead, it looks like we're in a long period of adjustment, moving away from the emergency policies of the past few years towards something more normal, but definitely slower. The next few months will be critical. More data on inflation, jobs, and consumer spending will hopefully give us a clearer picture of where we're headed. Until then, it seems that both the markets and all of us at home are going to remain cautious. And that's the reality behind the numbers. You're watching True Lens, where we keep America in focus. Thanks for watching.